Have you ever bought something like a bundle deal? Maybe a phone and a plan or like a vacation package.
Oh, yeah, definitely.
And you sort of wonder, how does the company actually figure out the price for each separate thing in there? It's not always clear, is it?
No, not at all. It can get pretty complicated behind the scenes.
Well, companies face a really similar challenge, maybe even more complex, when they issue different kinds of stock, like preferred and common stock, together, all for one single payment.
Right. How do you split that cash up fairly?
Exactly. It's not like you can just, divide it down the middle. So today, in this deep dive, we want to unpack two key ways accountants handle this: the proportional method and the incremental method.
These are really fundamental methods, super important, especially if you're, say, studying for the CPA exam.
Yeah, absolutely. So think of this as maybe a shortcut to getting your head around a tricky but essential accounting concept. We're aiming for clear explanations, some solid examples.
And hopefully a few of those aha moments, right?
That's the goal,
Yeah.
making those dense rules finally make sense.
Okay, but before we really dive in, just a quick reminder. This deep dive draws heavily on material from Farhat lectures.
Hmm.
All the content, the examples, the explanations we're discussing, it all comes from the great resources over at farhatlections.com.
Yeah, they've got a ton of useful stuff.
Absolutely. So whether you're an accounting student, prepping for the CPA, or already a professional, definitely check out the website for more practice, videos, and support on today's topic. And a big thanks to Professor Farhat for providing this material.
Definitely. Okay, so where should we start? Proportional method.
Yeah, let's kick off with what you might call the ideal situation. Imagine you're looking at a company's transaction. They've bundled preferred and common stock.
Okay.
The dream scenario, the sort of golden ticket, is when you know the fair market value, the FMV, for everything in that bundle.
Right, when you have all the pieces of the value puzzle.
Exactly. And when you do have all those pieces, that's when we use the proportional method. So what does this method actually let us do? Well, the great thing about the proportional method is it's designed specifically for when you do have reliable fair market values for all the securities involved.
Okay.
The main idea is really about fairness, reflecting economic reality. You take the total cash you received and you distribute it proportionally based on what the market says each piece is worth.
Right, based on their fair values.
Exactly. It mirrors the actual economic weight of each security in the bundle.
That makes a lot of sense. So let's maybe walk through an example from the material to make it concrete. Say a company issues preferred and common stock together, gets one lump sum. How does the proportional method start breaking that down?
Okay, so the very first step, absolutely critical, is to determine the fair market value for each type of stock.
Nail down those FMVs.
Precisely. So let's say the preferred stock's FMV is $60,000 and the common stock's FMV is $40,000.
Okay.
You add those together. So $60,000 plus $40,000 gives you a total combined fair market value of $100,000.
Right, that's your total pot, the total market value.
That's your baseline, exactly. Your anchor point for splitting up the cash.
And that baseline lets us figure out each one's proportional share, right? So preferred is $60K out of $100 K total. That's 60%. And common at $40K is the other 40%. Those are our proportions.
You got it. 60%, 40%. Once you have those numbers locked in, you can allocate the actual cash the company received.
Okay.
So let's say the company got maybe $90,000 in cash for issuing both types of stock.
Right. Not the full $100 K FMV, but $90 cash.
Exactly. So you apply the percentages to that $90,000. Preferred stock gets 60% of $90,000, which is $54,000.
Okay, $54,000 for preferred.
And common stock gets its 40% share of the $90,000, so $36,000.
$36,000 for common, and 54 plus 36.
Yep, that adds back up to the $90,000 cash received. Perfect.
Exactly. It ties out neatly. The proportions distribute the entire amount received. So we figured out how much cash goes to preferred, how much to common. What's the next step? Recording, right?
Yeah.
How does that look in the journal entry, especially with, par value and APIC?
Yeah, the journal entry is where you formally record this allocation. So first, you debit cash for the full $90,000 that came in.
Right, cash goes up.
Then for the preferred stock piece, you credit the preferred stock account for its par value. Let's just say that's $10,000 for this example.
Okay, credit par value.
And the rest of that $54,000 allocated to preferred, which is $44,000, 54K minus 10K par, goes to additional paid-in capital, or APIC, specifically for preferred stock.
Got it. Credit APIC preferred for $44K.
Then you do the same thing for the common stock. You credit the common stock account for its par value. Maybe that's $5,000.
Okay, 5.0 par for common.
And the remaining amount of its $36,000 allocation, which is $31,000, 36K minus 5K par, gets credited to APIC, common stock.
No, okay. So you end up with cash debited and then credits to both stock accounts at par and both APIC accounts for the amounts above par. It perfectly breaks down that 90K.
Exactly. It meticulously shows how much cash supports the par value and how much represents capital paid in excess of par for each class of stock.
So thinking bigger picture,
Yeah.
beyond just getting the accounting entry right, why is this method, this focus on fair market value, actually important?
Well, it's crucial. It goes beyond just passing an exam question, though it's definitely important there too.
Right.
It directly impacts how a company's equity section looks on the balance sheet. When you allocate based on FMV, you're saying, this is what the market thinks each part is worth.
It reflects reality better.
Yes, exactly. And that influences how investors see the company. It can affect future attempts to raise capital. It really impacts the perception of the company's financial health. Understanding this lets you sort of decode what's happening financially.
Okay, that makes sense. So proportional method, clean, elegant when you know all the fair values. But life isn't always that neat, right?
Definitely not.
What happens in those trickier situations?
Yeah.
What if you don't know the fair value for every single security in the bundle? You're missing a piece of the puzzle.
Yeah, that's a very common scenario, actually, and that's where the incremental method comes into play.
Okay, incremental. How does that work?
This method is the go-to when you only have a reliable fair market value for one of the securities involved, not all of them.
That's one. Okay.
Yeah, and the logic is pretty straightforward, almost practical. You allocate the known fair value first. Whatever cash proceeds are left over after you assign that known value, that remainder gets assigned to the security whose value you don't know.
Ah, so it's like a residual approach.
Exactly. It's sometimes called the residual method, too. You allocate what you know, and the rest, the increment, goes to the unknown. It essentially acts like a plug figure to make sure all the cash gets accounted for.
So it's kind of like saying, okay, we definitely know this piece is worth X, so we'll book that. Whatever cash is left over must be for that other thing, even if we don't have a direct market price for it.
That's a perfect way to think about it.
What kind of other thing are we usually talking about? What securities often have unknown values?
Well, often it might be things like warrants attached to bonds, or maybe a class of stock that's brand new or doesn't trade often, so there just isn't a reliable, active market price readily available.
Makes sense.
And just to quickly illustrate, let's use that same $90,000 lump sum again.
Okay.
But this time, let's say we only know the fair value of the preferred stock, and it's still $60,000. We don't have a reliable FMV for the common stock.
Right. Only no preferred.
So using the incremental method, you'd first allocate that known $60,000 fair value to the preferred stock.
Okay. Assign the 60K.
Then you look at how much cash is left from the total $90,000 proceeds. That's $90,000 minus $60,000, which leaves $30,000.
$30,000 remaining.
That remaining $30,000 is then assigned or allocated to the common stock. That becomes its accounting value in this transaction.
So the common stock's value here isn't based on its own market value, but on what's left over.
Precisely. It's determined residually, incrementally. That's why the name fits so well.
Yeah, that really clarifies the incremental part. Okay, let's try and pull this together then. Comparing these two methods, what's the key takeaway? And why should, our listeners care about this distinction, whether they're studying or just trying to read financial statements?
Okay, so the fundamental difference is proportional method is for when you know the fair market value of all securities in the bundle. It gives you that market-based, really precise allocation.
Right. All values known.
Incremental method is your tool when only one fair value is reliably known. You allocate that known value first, and the remainder goes to the unknown security.
One value known, allocate the rest.
Exactly. And both methods are super important. You absolutely see them on the CPA exam. The questions often test if you can identify which situation calls for which method and if you can apply it correctly.
Yeah, I can see how that would be a common exam topic.
Yeah, definitely. And Professor Farhat's material, for example, does a great job clarifying potential confusion points, especially making sure you correctly calculate and allocate the AP pick amounts for each class of stock. That can get a bit tricky with the incremental method's plug value for one of the securities.
Ah, because the ABP for the unknown security is also determined residually.
Exactly. Getting that right can definitely save you points.
Even if you're not taking the exam, understanding these methods really helps you, like, peer behind the curtain of these complex deals, doesn't it?
Absolutely. It lets you see the logic behind how companies take this big chunk of cash and carefully assign it to different parts of their equity structure.
Mhm.
It's key to understanding what the balance sheet is actually telling you.
Right. It helps decode the numbers. So as we wrap up this deep dive, we've looked at how companies handle issuing multiple securities for one price, using either the proportional method when all values are known.
Or the incremental method when only one is known.
Exactly. Yeah. Hopefully, you've got a clearer picture now of when each method applies and why that choice is important.
So maybe here's a little something to chew on. The next time you read about a company issuing some complex bundle of securities, maybe try to guess which method might they have used.
Yeah, based on what information might be available.
Right. And think about why that choice actually matters for how their financial statements look and what it might signal to investors.
That's a great thought. And you could even think bigger, right? How might these allocation ideas apply elsewhere? Like buying a group of assets for one price.
For sure. The underlying principle of allocation based on value is pretty broad. Or, just find more examples maybe on farhatlectures.com to really hammer down the details.
Absolutely. Once you grasp the core logic, these methods become really powerful tools for understanding finance.